Okay, we are set. Let's do the face cam first. Hello, guys. I'm your boss, Joe Boss, and welcome to another weekly trade plan stream. Man, it's gonna be a good one. It's gonna be a good one. I gotta start the event in Discord. Let's see here. Can I get Discord to start the event? Yes, I can. There we go. So if you want to hang out, this is where we're hanging out in the events stage here. Bump, bump, bump. Every week, the weekly trade plan streams on Friday. We have the events stage set up, going alongside with the stream. So let me go ahead and I think I can share my screen over in Discord, just so that everyone who hops in on the Discord side. Also, that's really set up for anyone who wants to hop on the stream and say hi and maybe discuss something, because I'll just be frank, I don't have notes for today on anything specific. I have a couple of points I want to hit on, and other than that, we're going to be focusing on charts. And we want to do that, and we're good. Yeah, bit of a slow start to the stream so far. All right. This is Euro CAD, which is so far going as expected. That was our timestamp from yesterday's stream, and we've moved down, which is nice to see. We can do nothing's really changed for the trade plan we did yesterday on this, but there are a couple of things that do stand out, which is especially on Euro Dollar. I saw this one earlier and I was gonna bring it up, and I was like, oh my god, that looks great. But again, you know, if things go well with things at the Strait of Hormuz and defanging the Islamic Republic, I would not be surprised if this is a more likely low for the month that comes through. It's very, very nice to see. Couple of losing trades here, but I've had other trades that have made up for it, and especially these Euro CAD trades, so I'm not too concerned. But I'm wondering, okay, what's like the timing for getting into this? And thankfully, we have another indicator here called the timing dots, which can help with that. We're going to adjust the settings a little bit here. And you can actually see there's like this row of dots right here. I can do this row of dots that also coincide with this peak right here. Right, dude. Yeah. So this is what I'm looking at, these dots right here. However, there is something else, and that is all these dots in the latter half of the month that I'm concerned about. See, this is saying, given this top, similar bottoms following this top for the month have occurred at all these different little dots. So there's a cluster of dots right around here. And if I go back to the pen option, and then we have a cluster of dots right here. Gotta watch what I'm drawing. But there's this cluster. They all kind of occur after this time here, so this might be too early to call a low. And that's what has me concerned about potentially going to these spots right here. Right? Because if you're going to bottom out around this price, right, that the range probabilities is pointing out, right, along here, you want to be somewhere after this line right there, right? Somewhere after this point. Because that's where all these dots live. So reaching a low earlier, and in my mind, increases the risk of seeing these similar data points. So I'm not too sure about actually seeing like another 200 or 300 pips of drop here, because the IEA is just unleashing all of this oil right now, and the United States is unleashing all this oil. Everyone's unleashing as much oil as they possibly can. Russian sanctions are being given exemptions. It's everyone is trying to manage the situation to the best of their abilities. We saw in South Korea and in France, they're putting price caps on gasoline and some refined products. But it's becoming more and more clear, based off of the research that I've just preeminently seen going into the week ahead, and we do this here. So if I go to the welcome spot here, so here's the Discord, the Plan the Profit Discord. We can zoom in here a little bit, and you can see this is the live stream in the event stage. But one thing we got in here is the trades forum, where we're following the Iran commodities crisis. There's actually this bit right here from CPI Edge, and this guy has an extraordinarily great track record at forecasting US, and now he's doing UK CPI. And this is his little bit that I thought was very, very interesting. It hits on a few things that I've brought up a bit ago, which shows a lot of people are watching it. And that's the fertilizer. And restaurants are another intensive energy sector. So essentially, one of the most accurate people I follow for inflation forecasts, at least in the United States, is expecting higher inflation, and for inflation to be a bit sticky for the next few months. Now, I'm bringing this up on top of telling you, hey, when I talk about doing trade research, this is what I'm talking about. This is just today. These are all the outlooks, week ahead outlooks, month ahead outlooks. There's some quarterly outlooks that got released. A lot of geopolitical analysis here. And frankly, Ani and Ari, both you guys have recommended me groups to find. There's a lot of things here that I would not know about to find. Like this one, this is a bank that Ani helped with, and then I believe not Westpac, but there's not RBC, ANZ, CBA. Those are ones that you helped me find. I mean, it's great when people come in and I ask them, hey, what bank, who do you bank with, right? You have a bank account, right? Well, obviously you bank with somebody. You spend your money somewhere. Who do you bank with? And when you have a bank account at these places, that those banks provide research for assets, for currencies and commodities and equities. It's very, very easy just to go to your bank and say, hey, I would like to open up an investment account, and then get access to their research desk. Now, you're not allowed in many, many, many situations to share any of that research. However, what distinguishes all of these outlooks is that, first off, these are publicly available URLs. There's no account in front of them. And secondly, when you actually go to the PDF or whatever page you're looking at, there's all these disclaimers that explicitly say, this is marketing material. This is a marketing communication. And there are disclaimers out the wazoo to absolve these institutions of explicitly this, someone sharing publicly available links to their analysis. But that's why these links and the information are publicly available. It looks like Discord's went a little jank on the voice chat there. Now, when you go to your bank and you get to their research portal, where you have to have an account to prove your income and that you live in a specific regulated area, and they start distributing research to you personally with recommendations, you cannot share that here. And I delete that stuff. And if it turns out something I've shared falls into that, I'm deleting it immediately. There are a handful of people who like to post that stuff, and I do not condone it, because a lot of those people, they just get their accounts deleted. But all this stuff qualifies as marketing material, even though they all write, hey, these are our outlooks. And guess what? They have PhDs and chief economists and heads of research, CIOs, writing, heads of banks, some of the most important people in banking are writing their own weekly articles and analysis on assets and what they're looking at the bank, what are the major macro themes that they're looking at, what individual assets they're checking out. And it kind of blows my mind that when people say, oh, you have to do your trade research, and then they don't even provide like, oh, you should at least talk to your bank about getting an investment account with your bank, and then getting bank. Like, so too many people just do not know really how to do trade research. And it's because that not necessarily that they were never told, but just because most people don't know where to go. They're told, hey, do trade research. And the most they'll do is arguably kind of just watch YouTube, pop finance stuff. That's what I mean by YouTube. But there's also guys on YouTube that I entirely, wholly endorse watching on YouTube. In fact, I was just watching this earlier before I got the stream started. Renmac, these guys here. And I can copy this link and make a new tab real quick. For this year and next year in terms. Okay. These guys, Renmac. I've been watching these guys, I think now for a few years. I've been watching those guys forever. And I'm pretty sure I posted their video, not necessarily in the commodities channel, but in the Around Commodities Crisis. Yeah, see, there's the video. So when I come across good resources, I'm going to share them. And even when they are resources I'm using very consistently for years now, because I've been reading a lot of this research for years now, and it has helped me significantly in setting better trading expectations and knowing when to ignore the indicators or what to focus on or what risks are ahead. And I gotta be frank, sometimes it doesn't even cover everything that you need to know, especially for a lot of assets. I mean, next week, actually not even next week, on the 15th here, in about 2 days, we have elections in France, and we have some elections in Germany coming up, and we have some elections in Spain coming up. And I have yet to actually see, even in a lot of the analysis that I've looked at here, like there's no geopolitical analysis. Yet when the United States is having the US presidential election, everyone is covering it. Yet these elections, don't get me wrong, they might not seem as important, but they have important consequences down the road. Where if your whole job is to be ahead of expectations, your whole job is to look ahead, figure out what's going to happen next, you want to know how even sometimes smaller elections can impact and change and be bellwethers for larger elections. For example, if we go to the one on the French presidential election here, this is actually forwarded from the 2026 municipal elections. So this is saying nearly 4 out of 10 French people say the outcome of the municipal elections in France, which have their first round on the 15th of March and their second round on the 22nd, will influence their vote in the next presidential election. It seems pretty clear cut. That's a big deal. And the expectation is that Jordan Bardella is very likely going to end up being the next president of France if, Le Pen can't run and doesn't seem like she will, or like isn't legally going to be able to, because of all the things that they've been doing to try and suppress the national rally. But guess what I have to do to find out about French politics right now? I have to listen. One of the few people in French politics that are actually constantly bringing on people are actually the far left socialists. The far left socialists are constantly putting stuff out on X and on YouTube. And I wouldn't say I'm necessarily an expert, but I'm getting decent exposure to, here's what these political parties are thinking and doing and what they want to accomplish when they're in power. And when they're in power, they want to change this fiscal policy and they want to have this monetary policy. They want to do X, Y, and Z legislation to allow this economic capacity and restrict that economic capacity. It's really important to know what people are going to do when they get into power. And it's better to just stay on top of it nice and easy over time, rather than literally a week before the election occurs or the day of after the election occurs. There's a massive market move in some major sudden quote unquote surprise to the election that occurs. But it's really not a surprise. If you were following the election in the early polling, it probably would have been staring you right at the face. You just weren't listening to anyone saying anything about those actual risks. You weren't following anything that was actually happening. So that's just rant number one, hopefully, for the day. But it's there's been a couple of things like that have bit me. And not necessarily bit me in losing money. I mean, bit me in, I probably could have made an extra like several hundred pips on trades. And the opportunity cost of doing that little bit of extra geopolitical research on those elections versus not doing it and not making that extra money by not knowing what's going on really hurts you. And I said this a few days ago in an earlier stream. But if you forget to learn these lessons and improve your research abilities and cover your blind spots as you learn more about the world, it's going to be more and more difficult for you to learn, okay, what do I need to research? What do I need to follow up on? And how are these things going to impact my trading? And what assets I have exposure to in my portfolio? It makes a huge, huge difference. I mean, having quantitative models helps a lot too. And frankly, sometimes having, AI help you do that research can be extraordinarily helpful. But in some situations, it can be hard to find enough media about certain elections, just to be frank. And that's what makes doing that kind of research actually a bit harder, quite a bit harder. So I like growing what I'm doing here with Plan the Profit and Boss Trading to get more people involved in the research process, show people at least how I do research. And who knows, maybe I'll learn something. I get it from Ari and Ani on a couple of places to get more research to help with building upon what I'm currently doing. Or even take it into some, new direction. Maybe there's something I totally didn't know existed. Oh, I think I have to stop the Discord. Yeah. Looks like I have to stop Discord. So if I do pkill 9 Vesk. Yeah. Yeah, something happened with the Discord. That kind of sucked. But everything should be fine now on the stream. I was getting some kind of a bitrate warning, and now that bitrate warning should be going away. So, sorry about that. Apparently, I shouldn't be streaming on Discord and live at the same time. So, sorry about that, but I'll let you guys know when I'm in the Discord voice chat again. So then if anybody wants to come hang out and chat and go over a couple of charts with me, we can absolutely do that together. Just getting it set up on a separate monitor here for the meantime. There we go. All right, I'm back in the event stage. So then if anyone who hops in is in the audience, you can raise your hand or whatever. There's that feature in Discord. Okay. Ari said run DXY weekly. We'll do that. Wow, check that out. Lot of dots. We're really towards the edge here of these ranges. And then big deal. I mean, this is super positive. Super positive momentum. Let's try a 6 hour. Yeah, it's exactly the same data, pretty stationary between a 6 and a 12 hour. Sometimes it's not so stationary. Sometimes the short-term data just moves things so significantly. The reason why you can see a change is because TradingView has different historical data cutoffs. So on a 6 hour chart, you get less historical data because you're just fed a certain amount of bars. So like you're fed 10,000 bars. Well, 10,000 bars on a 4 hour chart is going to cover a smaller period of time than 10,000 bars on a 12 hour chart. Let's see here. Oh, quarterly ranges. Okay, let's go ahead and check out quarterly ranges. Oh, that is kind of interesting. Holy smokes. Yeah, that is super interesting. So there's a peak in the distribution right here. And you can see that we were watching the U.S. government shutdown. I'm going to make this text smaller so it's not so distracting. But this is when we had the U.S. government shutdown, and you can see how we were trading around that, right? Shutdown start, long in the dollar, shutdown end. Outside of this 1 week right here, it's just been short the whole time except up until right here after the attack on Iran until the beginning of Operation Epic Fury, right? So yeah, I would not be surprised if the top for the quarter came in around the middle of the 100 handle here. Or in the upper half of the 100 handle. Yeah, Ari, that's a great find. That's a great little find right there. But given the rise in inflation, I also seriously would just not be surprised if we saw more movement into the US dollar. As central banks either have, a few central banks are back on a rate hike cycle here. A couple of them have. I can probably pull up the SEB research, but SEB has a nice, wonderful little table that goes over a bunch of different central banks and shows you the current odds in the futures markets of where rate cuts or rate hikes are being priced in for what meetings. It's excellent information, especially for currency traders who need to watch out for the rate of change in differentials, central bank rate differentials between two countries. And, a lot of people confuse that actually with yield spreads. And we're not getting yield spreads here because this is an index. So shouldn't have tried to load that. But it's very, very cool to see that the low came in closer to this peak. And that, again, I wouldn't be surprised if we went past this peak. I'm just saying, I wouldn't be surprised because when you go into trading major geopolitical events, you always have to be very, very open to the easy possibility that additional volatility comes in via developments in the geopolitical event that push price past places where indicators like this might say, hey, high probability of getting your top for the quarter around here, or your low for the quarter around here or around here. Those are probabilities, right? So we have to be open to the probability that these situations do not occur. So I would really like it if we did top out here. I really would like it if we did top out here. That would be very, very nice. But there's a few, I didn't get to totally read every single outlook, right? But I did see quite a few places that actually are still dollar bearish. And they're very, very kind of begrudgingly saying, like, yes, on the short term, we have to be tactically long dollar, but we are like desperately looking for the next dollar short opportunity, because as soon as this event with Operation Epic Fury resolves, and let's say we do get a transitory government in Iran set up proper, and oil facilities come online in Iran, and the Persian Gulf has free trade flowing through it again, and the Strait of Hormuz is no longer laid with a bunch of bombs and cruise missiles flying across the strait, it'll be a lot easier to commit to a dollar short trade. And frankly, getting short going into the, you could say, as those events start becoming more and more and more likely to actually materialize, it becomes more and more likely getting dollar short will be profitable. But I definitely do not know the timing. Definitely do not know the timing. And anyone who says that they know the timing is really pulling their leg. Like, for example, I was very excited when the IEA and the US and all these countries were coming out and saying, we're going to pull oil out of our SPR reserves, right? We can go and check out oil. Oil is just going haywire right now, right? I mean, look at this. That's not very easy to trade. So we're just going to hide this for now. So then we have a nice, easy chart to look at. But this thing can very easily continue going higher. Oil can very, very easily continue to go higher. Because until the attacks from Iran stop, this isn't going to resolve. And all of the oil facilities that have been turned off need to now be turned back on, and that's not an instantaneous process. I was also just saying something about France and the United States and the IEA are releasing all of this oil from their SPRs. Japan is waiting on March 16th, if I recall correctly, to release oil from their SPR reserves. This is saying reserves after SPR is kind of redundant, because they stand for Strategic Petroleum Reserves. That's what SPR stands for. So saying reserve after saying SPR is a bit redundant, but mind the gap, right? So all of the SPR reserves that are getting released, it's about 5 million barrels per day. The current cut to global oil production due to the failure to get, not necessarily the failure, but the incapacity to get ships through to load and unload commodities in the Persian Gulf, and frankly also in the Red Sea, is 20 million barrels per day worth of oil. There's other commodities like fertilizer and natural gas that are also hit pretty significantly. And you can even see from the few things that I just brought up earlier and from my prior streams, I expressed a particular concern about inflation in agricultural items and in food. We can look at soybeans. Let's see here. Oanda soybeans. Sure. You can see soybeans since the beginning of February have been going up, up, and up. But since the beginning of March, it's been getting much more volatile more up. It's up about 5%. Soybeans are up about another 5%. But there's urea. That's uranium. That's whole milk. This is nat gas. You can see this was actually where is it? Yeah, this is US nat gas futures in NYMEX. We want urea, and urea is this one, UFV. So this is fertilizer. And you can see fertilizer is actually going higher. This is how high fertilizer currently is. We're currently up 27%. And this is probably going to crack 600. This is likely going to go higher. This is not going to help with food prices because you need urea to help you with fertilizer. And you need good fertilizer to produce good yields. There's other stuff also going on. What's this with cocoa's up like 1.6% today? This is also the Bloomberg's commodity index. You can see since the beginning of March here, Bloomberg commodity index is up 11.5% roughly. Not great. Let's go ahead and put in a drawing here. Let's put in, where is it? A percent drawing. Yeah, price range right there. So from here to here. Okay, up roughly 11%. I believe this has bars, yeah. So you can see a bit more clearly exactly how this thing has moved. I would not be surprised to see this move higher. Absolutely not. I feel like we're going to take the elevator up and the escalator down for a lot of these assets that have been impacted by Operation Epic Fury, and now all of the supporting military operations from the rest of the world that are going into Saudi Arabia and Iran and Pakistan to kind of contain Iran. We can actually check out gold. Gold's holding up, but it kind of lost this trend here. So by the trend that I'm pointing out, if I could real quick, was going from here to here. And if you extrapolated it forward, let's see here, style, extend lines like so. You can see it hasn't followed this trend that was established here. So that's not great. That's not great. It's kind of fallen sideways. I'm not particularly sure why it hasn't continued to appreciate. Maybe one of the major reasons why gold is falling is people who have gold assets now are trying to sell them in order to compensate to acquire cash to get more expensive oil or fertilizer or whatever in order to bid on commodities that are needed elsewhere or to get better returns elsewhere. People divesting from a lower performing asset to a higher performing asset. That could also be it. However, if what I'm saying is that's expected to happen with inflation around the world, to see a stickier grind higher here inflation for the next couple of months, having gold in your portfolio is quite common practice as a hedge against inflation. So I wouldn't set out of gold myself. I think gold would actually do just fine, even if it's not going to follow this quite nice linear positive trend, all the way to 6,000, right? But what I do expect is, as the CPI prints of all these different countries start to come out, gold likely, I think, is going to start grinding back up as it goes into the mainstream of, all this disruption that's occurred in the Strait of Hormuz and the Persian Gulf is now finally funneling into CPI and PCE costs. So it's gonna be a little bit, but I would expect, especially going into maybe April and May, a continued positive drift here on gold for sure. Especially if you're also expecting higher inflation, like the few people who are paying attention to urea prices, like we are, right? Let's see, what else can we check out? How about this? Let's sort things by largest mover and smallest mover. So the dollar CAD has moved the most today. So how about this? Let's go to a 12-hour chart, look at the probability pivots. Now this is seasonal data, and I keep warning, hey, seasonal data will give you issues. And you can actually see right here, we're looking at the odds right now for the current week on dollar CAD, and it said, hey, 50% of the time, the top for the week, this particular week, comes in above R1. And when you have a strong dollar and pretty strong odds in the same direction that you would expect a strong dollar to go in, it looks pretty good. Also, look at that. Perfect little setup for a bullish range bias. Now, this is definitely overshooting, but it's also overshooting very close to the end here of the week. Let's turn on timing dots. And yeah, I mean, this might end up just being the top for the week right around here. Maybe it goes up. Oh. Maybe it goes up another, I don't know, 30 pips-ish. But based on finding a low here at this time of the week, at this entry point in the pivots, all these numbers and all these dots, it makes everything look so messy, but in reality, it's just saying up, right? And this is probably done now, at least for this week. Once you get into next week, now you have a whole nother thing to deal with. You have 39% odds of seeing prices above R1. So pretty, I mean, we can go ahead and just unbias this real quick. So we can see the entire distribution here, and yeah, okay. So we have something here called the probability gap. The nominal expectation, which is what I describe as the place where the highest probabilities are described to us by the indicator, is right here. So this is where most of the odds are. That's the biggest thing. That's where the peak is. Now, a probability gap is this spot here that says 0 between R1.5 and R2. So above R2, you have all the rest of the probabilities of where the top comes in for the week. And you can see it looks like a tail. It looks like a really thin tail in a distribution. So the idea in trading a probability gap is once price crosses this R1.5 level, well, if you were just trading, let's say, a standard bullish bias, like so, look at that. 26% of the time next week, if you actually had a trade that went all the way up, up, up and away past R2, I mean, it says, hey, in the last, I don't know, 20-something odd years, the top for the week doesn't actually occur here at the exit. In fact, it's occurred 0 times. The top has always occurred past R2 for next week. I mean, even in a more geopolitically sensitive scenario, I would actually be open to that personally. But the nominal trade plan is along these lines of staying between, getting your top between central pivot and R1.5, with most of the odds being between R0.5 and R1. Now, if that's not where we end up going, if we end up going higher, okay, fine. At that point, just being long biased takes care of that, frankly. And then we can look at the downside, right? So we're looking at dollar CAD because it had the largest performance move, at least in favor of dollar here on the positive side. We can always look at the other ends, but This is also saying, hey, most of your lows for next week occur between central pivot and S1. In fact, it's close to about 55% of closes next week seasonally occur down here. Now, again, given the geopolitical events that are going on with the disruptions in the Persian Gulf, we have to be open to potentially this thing just going and continuing up and running up. So it's really up to you. Do you decide to wait for a pullback to buy some nominal expectation of where seasonal lows occur? Or just buy a continuation higher? So let's go ahead and look through the rest. Pound yen. We can look at pound yen. Pound yen had a big move. Pound yen had a big move. And it also has a big fat peak right here with thin tails on either side. So for pound yen, if we were just trading this nominally, I would be okay with maybe taking some shots here between S0.5 and S1. And guess what? That's the entry for a standard bullish bias trade. So we can do that. Oh, not standard, range bullish. Yeah. I did one pivot too high. There we go. So 13% odds of a drawdown, 30% odds of a stop. We can actually turn on the dashboard here real quick, and I can move myself on over to the other side. And we can check this out real quick. So odds for next week. Standard bullish odds. Let's see here. Odds of hitting the exit, 34%. Same as the range bearish odds. All right. And 30% odds of actually overshooting the target with this bias. And 43% odds of overshooting the target with the range bearish odds. Oh, the range bearish odds, you only hit your stop loss 13% of the time. So, you know what? If we don't come way down immediately, if we don't run down, instead we get some yen weakness into the beginning of next week, maybe based on the odds, based on seasonal odds, the pivot bias setup that has the best historical odds here actually is the bias, the range bearish. And we can switch this to high odds and turn off the strategy dashboard because we don't need it anymore. And I can move myself back over. Yeah, and you can see right around there. So essentially a lower high, shorting a lower high and taking it back down again. So while it hasn't occurred yet, the trade plan for next week on this would be something along the lines of up. And we can make sure that's green. Slap on a timestamp for this, 2026, 03, I believe it's 12. No, 13. And give it 555 timestamp. And then down to make a lower low. And we can call that. And also give it the same timestamp. 0555. We'll have to see, because this is just a nominal trade expectation. This is not including any extra analysis that we are doing geopolitically in the trade group or in the Discord, in the trade forums, or in the research forums of the Discord. This is just looking at the odds on the indicator and taking it really at face value. So if we look at this, we can go down to a 6 hour here and maybe adjust this a little bit more. And then take this maybe down to. All right. And now let's go back. Okay. I am pretty satisfied with that. I just did a little bit of adjustment using the ranges to kind of help fine tune things. With pivots, you have very wide areas to trade. So if I load up Wayne's Pivots Pro here, And in Wayne's Pivots Pro, load up the bias we were just looking at, which is the range bearish bias. You can see we have these zones for entry and exit. This area here is 58 pips. Now, can you tell me where in this 58 pips am I supposed to actually be taking the trade? Do I take it right at do I take it right at R 0.5? And in that case, I might have to hold a drawdown all the way up to this ATR stop loss that we have set up. Now, maybe that's a bit too far for you, and instead you can tolerate using a stop loss based off of the pivot point stop. So we go ahead and use the pivot stop. And it brings that down just a bit, but, marginally. So if you just entered at R 0.5, your stop loss based off pivots, which would be the R 1.5 pivot for this bias, would be 134 pips. And you know what? We can even use a drawing for this, a trade drawing for this. So this would be your absolute most conservative P&L here, and it's like barely 1-to-1, where you enter at the most conservative location, you have your stop where it's supposed to be for this bias, and then you get out at the most conservative spot as well. If you did something which is essentially trading the middle of these boxes, you go short in this scenario. You go short in the middle of the box of the entry zone, and then exit in the middle of the exit zone, and stop still in the same location. Now you're talking closer to a 2 risk to reward ratio. It's a 1.88, but it's closer to 2. So where you decide to get in this range, and then where you decide to get out in this range, and this exit range is also much, much wider than your entry range for this particular setup. So it's not always straightforward with pivots to know exactly where to get in and where to get out. It's helpful that you have an entry zone and an exit zone. What we're trying to figure out also is where exactly in the zone is the best plus. And that's where a lot of people say, oh, well, the answer to that is just to, if you're taking shorts, then what you probably want to do is take short trades. You can do the exact same thing. Try and find short trades to enter based off daily biases. And I mentioned this in the prior stream, which is, it's very, very easy. It's a lot easier and a lot more consistent to set expectations on weekly chart timeframes or monthly chart timeframes, like so, and then figure out how to do execution on daily chart timeframes or rather intraday chart timeframes with daily pivots. And in the trading group, we have range probabilities, and I find this helps a bit more with those really fine grain pricing difficulties that pivot points tend to have, which is why you saw me doing this little extra maneuver of like, okay, I'm gonna just squeeze this closer to the higher end of this peak here, where the probability is a bit higher, because you can see these bins for range probabilities is a lot more, you could say, well defined. It's a lot smaller, more granular, but there's no bias in that indicator. Your bias in what peaks and troughs you exit or enter at are entirely dependent on the research that you're doing and what your convictions are to enter trades or get out of trades. So it's another stream of me emphasizing, oh, we have to actually read the research and we have to actually know what we're doing. So we'll go ahead and follow up with this. Excuse me. We'll go ahead and follow up with this as we get there, and we can even set an alert here. It'd be nice to have an alert there just in case things actually do work out. Boom. All right. And we can move on to maybe another asset. How about the NQ? Let's do the NQ. So NQ had a nice little bounce. Nice little bounce. It's still pretty choppy. There's not much I can really say here. Actually, now that I have the indicators on, there's a bit I can say. That's probably the low for the month if we're not going any lower. So if I turn on the timing dots, and let's go ahead and increase this a bit. A bit more. So if the low is somewhere around here, the ideal path for bulls would be to get your top around here, so a slightly higher high, or just to end the month higher, somewhere around here. But there are a lot more dots on the downside. There actually is a little cluster of dots right here over Monday and Tuesday of next week. So maybe there's some kind of gap lower that can occur that can take us to these lower lows. So that's assuming this is the top for the month. Or if you're more bearish, this is the spot to look at, which is essentially right on 2300. Now, I don't have any particular strong expectations for how the equity markets are going to move. However, I am going to be very curious to see how these equity markets react to stickier inflation over the next couple of months. I don't think central banks are going to significantly change their expectations over this inflation. I think they're just going to stay either on hold, and there's a handful like the RBA that are doing a hike, right? But I think the amount of rate cuts expected is going to be going down a bit. And when those rate cut expectations start to fizzle away as inflation comes in, maybe over the next couple of months, if it does, right? We'll see. Then we could actually be in a bit of a world of hurt for the next few months, at least on the DXY side of things. That would move DXY considerably higher. It would just grind higher over the next couple of months. So maybe the right thing to think, given the risk of higher inflation for all these different countries, putting central banks on hold and reducing expectations of rate cuts for a lot of these central banks and a lot of these countries, and especially for the United States, is that the dollar might end up grinding higher over the next couple months until production comes back online in the Persian Gulf, the disruption stops, and Iran is effectively contained. So I don't necessarily know we'll see huge ripping, sky high volatility spikes and price appreciation in the dollar. I think we've effectively already had that, right? This is a 2% move already. What I'm saying is maybe we see a positive trend here in dollar now over the next couple of months, given the risks of higher inflation over the next little bit here, putting the FOMC on pause and reducing rate cut odds later on in the second half of this year when, I believe there was a rate cut at least expected in June, and I read a few people were expecting a cut in September. We might shift those over one meeting. So the cut expected in June gets shifted over to September, if I recall correctly, and then the expected cut in September gets maybe, moved over to December. And that might be enough to set more positive drift expectations on something like the dollar here. And that could add pressure on a handful of commodities like gold. Don't get me wrong, I just said some very nice things about gold. But a stronger dollar does counteract the maximum potential return gold can have. And there are other assets like oil right now that are a bit less sensitive to that scenario due to the sheer demand that has to be made up in that 15 million barrel per day shortfall from not having access to some areas in the Red Sea and the Persian Gulf for exporting commodities. Okay. I think that was a good cover. So I'll go ahead and just say hi to anyone who's in the chat. Yeah, so if you guys want to hang out now, now's the time to come to the event stage, to come hang out and say hi. And if no one shows up, I'll just be here for the next 5-ish or so minutes. I see Ari just posted something in that's Financial Juice related. Let me see here. Financial Juice. What's going on? Saudi Arabia cuts. Gotta open it up. Yeah, Saudi Arabia cuts oil output by at least 2 million barrels per day. 2 million barrels per day to at least. What's that? 8? Oh, okay. I was reading that as Saudi Arabia cuts oil production to 2 million barrels per day. I misread that. I was like, no. They got, output was cut 2 million barrels to around a level of 8 million barrels. Million barrels per day. Gotcha. All right, so that's not great. That is not good. And I'm actually going to go into the news feed section here of the Discord. And I'm pretty sure that's right here. Yeah. And then we're going to forward that into the Iran commodities crisis thread right here. And now you can see Japan decides to release oil reserves on March 16th. France's President Macron, U.S. sanctions waiver on Russian oil products are temporary and limited. Let's see, anything else? Short-term interest rate futures hold on previous gains after economic data. Traders bet on a rate cut by September. Okay, so the odds did move. See, I didn't even read that, but that's how you know I know what I'm talking about. The markets already are moving in that general direction. It's very, very nice to see when you can take in a bunch of different information, come to a conclusion on your analysis, and then see other competent analysts that you admire or that you respect say either the same thing or come to the same conclusion even through different means. Hopefully those means were logical, right? But it's very, very nice to see that there is a reaction right now in U.S. interest rate futures based on just what I already just discussed and expected. I didn't even read this earlier. Very, very nice to see. It's very, very nice to see. Oh, yeah. That's always been my rule of thumb for determining whether or not someone is actually good at doing their own autonomous trading research. And that rule of thumb is when you have read enough research and you are competent enough now to actually understand and interpret the information that you are receiving, and you really relate with what everyone else is actually doing in the world of financial analysis, market analysis, trading analysis. You actually understand what's going on and you can relate with what's actually happening beyond just logically comprehending what's going on. It then leads you to, on your own, autonomously come to the decisions that you come to in trading. You automatically come to them. You logically come to them. You naturally come to them. So over the course of, let's say, that goes even frankly as a little diversion there into the fallacy of it takes years and years and years and years to get good at trading. Now, there's a bit of truth in that to a good degree that can be true. But a lot of the time it's used as an excuse to wave away people who are consistently losing money and chronically losing money the entire time they're learning how to trade, right? Instead of showing somebody the right way to do research right off the bat, they're just told, oh, if you just wing it, after like 3 years, you'll start making money. That's not how it works. You need to have a plan. You need to have a strategy. You need to know what to do. And even then, you need money to get into trading. It's not a free gig. I mean, that's just the reality. It's a major reason why people are lured into leverage, right? But now I've touched on a couple of topics there, and I've kind of lost my place. But that's just all to say. When it comes to following trading expectations and following other people's trading expectations, it's really nice once you've been doing it for a while to be able to set your own expectations that align with what actually is happening in the market. Your expectations are, quote unquote, realized. And when your expectations get realized or are met more frequently than not, you tend to be a competent trader. And when you can autonomously make on your own, come to the conclusions that you need to in order to have those expectations realized frequently enough, at least, it's incredibly straightforward. To just keep on keeping on, just to keep on setting those expectations and keep on doing your research and keep on following what has worked at that point. It actually, don't get me wrong, it's work, it's a job, it takes skill, but it becomes easier at that point the more you actually do that. And all the stuff I'm talking about doing to get better at trading is free stuff. I have a trading group and I have indicators and I have all these things, but all the research that I'm talking about is free. It's like, it is not behind a paywall. All the stuff that I'm talking about when it comes to just having a Squawk chat, reading research from banks, getting access to the research portal from people you actually bank with, like, these are things, just very, very common sense things that people are never told or explained, that are actually really good ideas that get people way, way better at trading much, much faster than even some of the best and well-intentioned advice. Now, don't get me wrong, some of those reports and some of that research is thick, and you need to know what you're doing. You have to build up competence to actually read a lot of those outlooks, to actually understand why and relate with why a particular analyst that you're reading from who wrote some report is actually setting XYZ expectation for ABC assets. So if things are going right over your head, it means you have to learn something. It means you have to get better at actually understanding the literal concepts, the logical steps that people are taking to come to a particular conclusion. And then once you can actually read a handful of weekly outlooks without stumbling over your own thoughts, you can actually start to relate with why the analyst is doing what they're doing. At that point, you become competent, and then you can actually understand, oh, this is why this person is doing. And at that point, you actually relate with what the analyst is saying. Then you keep reading the weekly outlooks, you keep reading the monthly outlooks, and you learn a bit more. And you get good at actually understanding maybe what they're going to say next. And then there comes a point where before they even release the next week's outlook or the next month's outlook, you've already collected enough information on your own, maybe via Squawk chats or news articles or other analysts or guys like me on YouTube or other guys on YouTube. You end up with your own, on your own, an autonomous expectation that's come from yourself. And when the next weekly outlook actually comes out, the next monthly outlook comes out, it matches your expectation. It matches what you autonomously came up with before they wrote the paragraphs and paragraphs of analysis, before it actually came out. You thought about it first before they wrote it down, or roughly at the same time they wrote it down in real time. But at that point, you know you're good. Or at least you know now you're on the right track to doing things that materially help you as an actual lifelong skill to doing decent research. Now, that's just getting good at doing the analysis and staying on top of stuff. Coming with your own research is a whole nother process. Doing data analysis on financial markets and staying really, really ahead of expectations and providing research on things before people are like a lot of people bring up, for example, of really people who were really ahead of expectations were all the people in the United States that The Big Short is made out of. During the great financial crisis in the United States, there were all these traders who, for 2 or even more years, stayed short the equity markets in the United States in different places, or they were short these fancy derivatives. But they would stay, they got massively underwater. They had huge drawdowns. There is such a thing as getting ahead of expectations to a fault. You want to set expectations and then be realistic about the time frame for those expectations to be realized, which is another subset in the skill of doing your own trade research and getting good at then setting expectations and then getting good at setting the time frame for those expectations to be realized. And then the next level is doing your own data analysis and writing your own outlooks and whatever. That's most people don't have the time for that. People have other jobs and stuff they want to do. And a lot of the data used to make really particularly excellent outlooks is, first off, not easy to wrangle and expensive as hell. So unless you're working at a bank or at an exchange or at a legitimate prop shop, not a prop firm where you take like $50 to get an account. I'm talking about a proprietary trading firm that has Bloomberg terminals at every desk, right? Those guys, they spend a lot of time wrangling the data, doing all sorts of statistical analysis on the data, so then they can set better trading expectations on top of develop whatever trading models that they want to create that are either automated or discretionary or whatever. At that point, the topic becomes very, very broad. So let's see here. Alrighty. So I think I had another good rant there. And you know what, my man? I think I'm good to end here. Nobody hopped into the stage to ask questions this week, sadly. But you know what? I am looking forward to when there's more people in the streams, there's more people watching. I'm looking forward to when there's more people helping doing trade research. I'm looking forward to when there's more people helping doing geopolitical research. I'm looking forward to when there'll be more people in the event stage asking, Q&As and whatever. And I'm not too concerned about whether it'll happen or not, but more or less when. There's definitely enough people in the world who'd love to hear this kind of stuff. and I bet that there are people who I could definitely learn from, and maybe share a thing or two with you guys on that here in the stream that come and join the community. So, with all that said and done, I'll say thank you guys very, very much for hopping in, stopping by, and I will see you all in a bit.